So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. On today's call, we're going to help you explain what option intrinsic value is so that you have a better understanding of it moving forward. And we're going to use a very simple example to help prove this point because option intrinsic value is actually very simple to understand. So there's basically two broad categories of option pricing, or broad components of an option's price. There's the intrinsic value and the extrinsic value. So as the names suggest, one is potentially internal value and the other is external value. So things that are not necessarily present on a basis right now. When it comes to intrinsic value, all intrinsic value is for an option price is the value that could be derived if the option contract were to be exercised or assigned immediately by the long option buyer. And so when it comes to a call option, this would generally mean that if you exercised your long call option, that you would derive some amount of value immediately for the shares that you got delivery of and could resell in the market. So let's use a very simple example. Let's say that you are a long call option buyer and you have a long call option at a strike price of 100. So you bought the 100 strike call options. If the stock is trading at $105, then your long call option has at least $5 of intrinsic value. And so what that intrinsic value is the difference between your strike price and the price at which you could sell the shares should you get delivery of them immediately by exercising your long call option. As a 100 strike long call option buyer, you could exercise your contract, take delivery of the shares and purchase them for the $100 per share and immediately resell them in the market for $105 per share. So again, the intrinsic value, or the value that you have in the contract right now, is $5. If the stock price was trading at 107, then your intrinsic value is $7. If the stock price is trading at 120, then your intrinsic value is $20. So it's a very simple way to look at the intrinsic value part or component of an options price. Now let's look at it on the other side of the spectrum here, in the sense that let's say you still are that 100 strike long call option buyer, but the stock now is trading at $98. Well, now your long call option does not have $2 or negative $2 of value. It just simply has no intrinsic value. Now, this doesn't mean that the option contract is worthless yet. It still might have extrinsic value, which is comprised of time decay, volatility, etc. But if you were to exercise your long call option at $100 strike price, you would buy stock at $100 and then seemingly sell it back at $98, which would create a loss. And so therefore, you would actually never entertain that option contract exercise because it would create a negative loss position in your account. So the long call option at 100 strike has zero intrinsic value whenever the stock is trading below the strike price. Now, if we look on the other side of the option pricing table and we look at put options, the same thing is true of a put option contract, just in reverse. Put options have intrinsic value whenever the stock price is trading below the strike price. Call options have intrinsic value whenever the stock price is trading above the strike price. So if we were a 100 strike put option buyer and the stock was trading at $95, then we would have $5 of intrinsic value for that put option contract. We could exercise our put option, sell stock at $100, which is the strike price, and repurchase the shares in the open market for $95, creating a $5 profit, which is the intrinsic value. So again, it's just a matter of which side you're looking at and where the stock price is relative to the strike price that you're trading. But again, intrinsic value is pretty easy to calculate. It has no real merit or no real understanding to implied volatility and time decay and all these other factors that are a little bit more complicated to calculate. Intrinsic value is easy. It's either there or it's not there. And it's basically the difference between the stock price and the strike price if you have a profitable outcome for that particular scenario. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, Happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.